This is For Advisors by Advisors. I'm your host, Evan J. Mayer. And today we have a very special guest in Mr. Michael Kieffer. Michael is the co-founder and portfolio manager for KR Capital. There's actually two of you, is that right?
There is.
A partnership, and fairly new, just started a few months back. I saw some back testing, some pretty cool stuff, but I met Mike about 8 years ago. Mike actually came in with some family members. They had some need for financial planning and some other options on portfolio management. And I've been keeping in touch with Mike probably once every quarter, probably a quick hello, how are you? Everything good? And watch you transgress, or what's the right word for that? Evolve into what you're doing today, which is really exciting. And you've seen our practice evolve too, which is kind of neat. So Mike, how are you?
I'm excellent. Thank you for having me on.
Give us a little history. You started in the business a little differently than most. Most people, financial advisors, come into the business and they're looking to expand the growth of their portfolios and then promote themselves and get better at what they do and then go more into the portfolio management. You kind of went a little bit of a different route. Talk a little bit about your past, your history.
Yeah, so my background, my first job was for a trading desk. In 2003, I became a professional trader called prop trading, and I got a Series 7. And instead of trading client capital, I only traded firm capital. So the firm would basically give you capital to trade with, excuse me, and you'd go out and you'd have to kill what you eat. And if you performed well, there would be a payout, a split, and that's how I brought home a paycheck.
And those are hard. I actually know a lot of people that like, I think there's these programs out where you actually pay. They teach you, then they give you capital, and then if you're not doing good, they basically tell you to get lost.
Yeah, so the reason why they do that, the capital is really to protect their own capital. Most of them will let you lose what you put in. So if it's a $10,000 training fee, that's their buffer, and they'll go ahead and they'll sponsor you and give you capital. But once you lose $10,001, they're going to ask you for more money.
And yeah. And how long did you do that for?
I started in 2003. I did that until about 2013 full time. So in 2013, I transitioned from trading firm capital to trading client capital. I did open my own advisory business. I was a registered investment advisor in 2013. I started Kieffer Capital, and I did that from 2013 to about 2020.
Now talk to me about that period of time, because your philosophies are a little bit different in what you're doing today versus what you were doing. A little bit more belief in individual stocks and the ability to short specific equities when you thought there was an opportune time. Talk a little bit about the difference.
The difference now is I don't do any single stock exposure. You have to learn from your mistakes. And my mistake is thinking that I know what's going on inside a boardroom, and I know what's going on for individual stock picking. I don't have my own personal research team, my own analyst. I mean, to think about the resources that it takes to get something right on a stock. For me, it's way easier just to follow the markets. So I transitioned from single stock investing to just index investing.
And that happened over the last couple of years here.
Yeah, so my partner and I, we started developing a model. The model looks at over a dozen inputs. These inputs, some of them are very specific to the market. Some of them are not specific at all to the market. So it'll look at things like the performance of junk bonds. Why? Well, junk bonds are the companies that are most likely to go belly up in a recession. They have the worst balance sheets and the highest risk for an investor.
Which makes them junk bonds.
Which makes them junk bonds.
Yeah.
But if you're willing, or if you see that the market is buying junk bonds, in general, that's a positive sign that they believe that the environment for risk will be lower in the future and they're likely to get their capital back, right?
Yep.
So that's one of the 12 inputs that goes into it is, okay, what are junk bonds doing? And you saw the top that occurred in November of last year. Just go look at junk bonds. They told the future. People were starting to deleverage and were getting a little nervous about the future long before we saw any correction in equities.
And out of these 12, what would you call them?
Inputs.
Yeah. Out of these 12 inputs, are they all market related?
Yeah. So,
and how much fixed income related versus equity related?
So the only part that's fixed income would be the junk bonds, and there's also the long bond. I look at long bond because long bond has historically, it's been a safety trade. If you look at the 60-40 portfolio, the 40% is supposed to balance you in times when the 60 is not doing so well.
Yep.
This year happens to be the second worst year on record since 1931. I believe the 64 portfolio is about 21% in the red for the year. But that's an
Shocking,
anomaly.
isn't it?
Yeah,
But,
that's an anomaly.
but does it say that modern portfolio theory is somewhat dead?
No, you have to look at things not in a vacuum. For the last 35 to 40 years, we've been in a bond, I don't want to call it a bond bubble, but we've been in a situation where interest rates have been steadily declining. And now we might be in a situation where interest rates steadily increase. And it has to do with inflation, has to do with all the money that they've printed. There's a lot of reasons why we may be changing regimes, but we are, and it's going to take a little time for that 60-40 portfolio to, in my opinion, to find equilibrium.
Yeah, and we'll see if that happens. The M2, which is the money supply, is the thing not talked about. Actually, one of the economists I follow, Brian Westbury, talks a lot about this, and that just raising interest rates doesn't necessarily get the M2 down. And so there's a lot of components that come into that. I have not been a 60-40 guy for the last 5 or 6 years, and thank God not this year specifically. But yeah, you're right. Does it come back? I don't know. Does inflation come down? I think there's a lot of unknowns. So you started this fund. Talk to me about how you met your partner.
We're neighbors.
Okay.
I had gone, after I left my RIA in 2020, I went back to prop trading. So I'm currently still a prop trader. And I said, you know what, dealing with clients and dealing with their emotions, that's a different business than just generating alpha.
Yep.
And my personal risk tolerance may be different than my client's risk tolerance. And I was okay with myself going and having a bad month or bad quarter. I was really having a hard time explaining that and having those conversations with clients. So I didn't really want to come back, to be honest. He essentially begged me, and he said that I have 20 years of all this knowledge. And he's like, why wouldn't you give that gift to the markets? Like, why wouldn't we make something out of this? And I told him if I did this again, I'd do it completely differently. And I wrote down all the things that I wanted to change that I had done previously.
Yeah.
And we had mentioned this prior to the show starting, but I read this book by Ray Dalio called Principles. And if you haven't read Principles, every single person needs to read Principles. And Ray's biggest thing is looking at yourself and writing down all the reasons why you failed and all the worst things about yourself, and then putting people in your life to surround you to help you to fix those inefficiencies. And that's what I did. So all the things, meaning, we mentioned this before, but I'm an eternal pessimist. And in a roaring bull market that we've had for the last 15 or 20 years, I've underperformed. Had I been an optimist, I'd probably be much wealthier than I am today. My partner is an eternal optimist. So if I'm a pessimist and he's an optimist, the two of us, we tend to meet in the middle. And that synergy, we essentially make a market amongst ourselves. And finding that common ground has been the key to our success.
Talk a little bit about how you got the hedge fund started. What was the process? Did you go through an attorney? What steps did you have to take?
Yeah, so for the advisors listening, a hedge fund is a very simple product. It's a limited partnership, and it's managed. So you have your limited partners or your investors, and there's a general partner, your GPs. And the GPs get to hire an advisor. Now, you could be your own advisor to the fund, which most hedge funds are. But in general, you do need to hire an attorney because you are a private security. And the same way that a public security has a prospectus, so a mutual fund has a prospectus, a hedge fund has what's called a PPM, which is your private placement memorandum. And you need to have that written by an attorney. Because when a limited partner invests in your fund, that's essentially what they're signing up for. So what you say in that PPM about what you can and can't do, it's essentially like,
it's your prospectus.
It's your prospectus.
Yeah, by all accounts. I was lucky to be involved in some investment committees at some of the banks and institutions I was at, and track record is obviously something that they want. Now, I've looked at kind of how you guys have performed over the last few months, and are you finding that difficult? And the concept that when you're talking to these institutions, are they saying, hey, come back when you get 3 years, or come back when you have 5 years? Are you getting that kind of pushback?
Absolutely. You will not get an institution to invest without 1 year. And the reason being is that analyst or that money manager, he has his own job security to worry about, and he's not going to invest in a fly-by-night type miracle operation. What you will get are family offices. So we are currently working with several family offices who are making investments with us, friends and family. So the growth cycle of a fund is your first year or two, you're starting with friends, family, single and multifamily offices, but where there's individuals making decisions, not several layers of decision makers.
Yeah.
And solo RIAs. So one of the family offices we're working with now uses Schwab, and another one uses Fidelity
As their custodians.
as our custodians.
Yeah.
We're getting onboarded to Schwab and Fidelity.
Okay.
Because once I'm on Schwab, any advisor who custodies with Schwab can allocate to our fund, and it won't affect their advisory fee. And it gives them the control where they can always pull it if they felt like it was no longer right for their client.
So in essence, if they had money in a managed portfolio, they were using Schwab as an example, and they said, "Hey, we want to, give $2 million over to KR." Then it's pretty much an easy process to do.
It's a very easy process. We show up as a line item on the statement. There's a clearing firm that takes our NAV. It gets ported over to Schwab. And the advisor still, like I said, we don't want to compete with the advisor on AUM. So if you had to send that money out to me, that's going to cost you $2 million of AUM to do business with me. We're trying to get it where we can only be a value added to you. If you were to allocate $2 million to us and we still perform well and we have a 10% year, well, your AUM just grew by 10%.
And as far as the scoring system that you have, which you've patented, you patented it, I guess, or you're going through that process?
We're going through the process.
Yeah. And it does do that back testing, which is great. And as you know, back testing is only as good as what happens in the future, because we've seen a lot of funds that did back testing. I guess you're going through this kind of market right now, which is almost perfect for a long short strategy.
Right.
And we're seeing long shorts have phenomenal years across the board. Talk a little bit about that.
Yeah, so what you opined on is the argument for maybe not the 60-40 portfolio, but maybe a 50-30-20. And maybe advisors need to start looking at alternative investments for 20% of their portfolio. There's a number there that makes sense where you're going to get absolute return. There are definitely years where the market will perform better than a hedge fund, but though we look at risk-adjusted returns. If all you did was buy the S&P 500, you're going to get what the S&P 500 does. But if the S&P 500 has a 50% drawdown, you get that too.
Yeah.
The idea of adding some alternatives into your mix, it's an asset class. Hedge funds are an asset class.
Yep.
And you're trying to just smooth out the volatility so that you get less of those phone calls, when things are going nuts. I mean, we're up nice this year, and I don't know how large a percentage of a portfolio we'd be, but hopefully we're offsetting some of those losses in the 60 and 40 that we talked about. So I believe that hedge funds, there's a lot of opportunity for them. They're kind of given a bad rap. More advisors should be using them.
So you've said two things that can be contradictory, which is you like passive management because picking individual stocks is hard to do, but you're active in your approach.
Right.
Talk a little bit about that.
We call ourselves a tactical index equity fund. So we're in the indexes. And I tell people the indexes, they go up, they go down. My fund, we can be long, we can be short. If there's a mismatch, we're in trouble. If I'm congruent with the market, we're good. So I built this model to tell me, is this a risk on or risk off environment? If it's risk off, then I'm going to be leaning towards short. And as long as the market goes lower, we're okay. And in risk on, we need to be readjusting the portfolio to be long the market. If the market goes up, we're okay. So what we do is we don't try to beat the market. We try to be the market, but be on the right side of the market.
And are you also looking at the VIX or volatility as one of those 12? You are.
Yeah. So the VIX is in there, just to give you kind of rundown.
Yeah.
We got the VIX, we've got junk bonds. I look at growth versus value. So the appetite for value over growth. What else? We actually look at individual price points of the index. The model knows highs and lows of different periods of time. So if you're making a new 52-week low, that's technically, usually lows make new lows and highs make new highs. Like when things are good, they can be good for a long time. But when things are bad, it can last for a while. So the score will adjust, and it knows not to get overly bullish. So today is an up day in the market, but the score is still negative because
it's not 4 o'clock yet.
It's not 4 o'clock yet, but we also haven't taken out previous levels of resistance.
Yeah.
So it knows those levels of resistance. So half the score is very technical and
So half of it is actually using technical spreads.
Correct. Half of it looks at technicals, it looks at moving averages, it looks at all, I'd say 6 or 7 of them is very specific to the market itself. And then the other 5 or 6 are these auxiliary things that we just talked about that really aren't the market itself, but shows appetite for risk.
And this scoring system you have, is it every morning you wake up and you're seeing where we're at? And is it using last night's overnight? And is it throughout the night?
It's actually calculating in real time.
Okay.
But we use the closing value because you just mentioned a lot can change during the day.
Yeah.
So I'll look at it at 10 a.m. and I'll say, you know what? If nothing were to change between now and 4 p.m., I know exactly what the score will be. But in terms of making decisions, most of our decisions are made between 3:30 and 4 o'clock because there I get to see, okay, what's going on. Now, an important thing about using models, and I'll be the first to tell you this, there's not a single indicator or a single model on this planet that will tell you the future.
Yep.
Nobody can see the future.
Yep.
What it can tell you is today, how are investors feeling? How are investors placing their money? And that changes on a day-to-day basis. Now, we call it a weather report. When bad weather moves in, it tends to stick around for a few days. And same thing, when there's blue skies, you'll get a bunch of, bluebird days in a row.
Yeah.
And the score doesn't change so fast. It kind of has like this oscillating degree to it where when investor appetite's changing, it changes for several weeks. So when our score flips, a flip to us is a positive to a negative. And on average, when we see that, it could last 3, 4, 5, 6 weeks where our score will either stay positive or stay negative.
You're a hedge fund, so as you were mentioning earlier, everything is a K1, so there is no capital gains, and you're not dealing with a ton of tax exposure to the client. How often are you trading?
Very often.
Okay.
So a typical holding period is 3 to 5 days.
Okay.
We're using a lot of options. So the way that we control risk is through derivatives. And we can so on Friday, the market sold off. And if you wanted to make a binary bet and say, you know what, I think the lows for this year are in, you can buy an option that below that level, it takes you out. And you don't have to worry. You sleep at night, and if we're going to have another 10 or 15% lower, that's somebody else's problem. We use that a lot. Typically, our long-dated options are 3 to 4 months out. So we like the 70 to 100-day range in terms of owning what we call delta, like you want to take advantage of a movement in the market. But we do the 60-40, part of our portfolio, we do sell theta, which is a time component. We were just like a covered call as a theta position where you're just trying to take an income. And we do that, but on a 3 to 5 day basis, but it's always hedged. So if I sold a covered call, I would own a put to protect me in case the stock that I own just bottomed out.
Got it.
Yeah.
Got it. And so it's all derivatives in the portfolio.
It's mainly derivatives.
Okay. Okay.
Yeah. Which is another reason why it really doesn't belong in an individual's account, or it doesn't belong, the average advisor should not be doing this kind of stuff.
Well, the average advisor couldn't do it.
Correct.
The average advisor wouldn't be allowed to do it wherever they were, and if they were independent, they still probably couldn't do it. And the ability to price that out to do it in one fund compared to doing it in individual accounts operationally just would be very hard.
Right? It's a nightmare. Yeah. And then you're going to get clients that get different pricing. Some may get a fill, you may get partial fills, running it as a single entity. So our fund, every night we run an expected shortfall report and a value at risk report. So as a manager, just having to worry about one basket of capital and say, hey, what's my exact risk on this account? When you have multiple accounts, you're going to have multiple personalities, multiple different risk tolerances. I love knowing that every night we go to bed, I know the world can end, a nuclear bomb, unfortunately, can go off somewhere, and I know what our portfolio will be at.
And these 3 to 4 month options, is that because the model doesn't tend to change from positive to negative, that often? So that 3 to 4 months gives you enough time value?
Yes and no. So we own, in that 3 to 4 months, both calls and puts. We essentially create this U.
Spread,
It's a spread.
Yeah.
But how we weight the spread. So if the model's positive, we're going to have more calls and puts. And also where we pick the delta, we're going to be deeper in the money. And we want more for the movement based on what the model is telling us. So we never not have both. That's why we're fully hedged. We always have a put, even in a rising market. But they may be way further away from the market. We may have a lot less of them. Those are the type of adjustments we make. So when you ask how often do we trade, the answer is very often. And we're constantly making adjustments and trading around a core position.
Yeah, and the core is normally one of the major indexes is kind of the...
Correct. Our universe, so we love the SPYs, SPYs and ETF, the Qs, and SPX options.
Okay, so you use that. And anything international?
No.
Okay, stay out of those international markets.
Well, that's not our forte. So my model doesn't work for international markets.
It doesn't.
I would have to redesign the model for what's important to those markets. So
got it.
Obviously, there'd be a component of the Dixie. Like you'd have to know dollar and FX and all that kind of fun stuff goes into emerging markets and
currency risks.
Yeah, currency risk. All that
right now is a significant.
We're a strictly U.S. domestic model. We're currently just a strictly U.S. domestic fund. We are in talks to open up a master feeder structure offshore. You don't necessarily want to invest in my fund with IRA money into a U.S. domestic because it potentially could open you up to UBTI.
Yeah. Do you ever blow out of the market? Are you guys ever do you close out maybe on a Friday and just say, you know what, we're going to cash this, while we wait? Because it's a very volatile time. The VIX is, well, prior to today, it was about 30, 31, somewhere around there.
Yeah, we have mainly it's to the upside. So we have our own internal metrics that when we're up a specific amount for a week or a day, we start pulling back a little bit of risk. It's never usually 100% cash. It's been, I'm trying to think. On Friday of last week, things were looking really hairy, and even our model's negative. We're so oversold short term. We got really small. We're about 90% cash today, to be honest. And it's not because we're going to be putting new capital at risk this week, but we're just waiting for things. This bounce that we got today, since our model's still negative, we're probably going to be purchasing more puts into it, right? Unless the model flips, unless the strength we see in the next few days is so strong that it makes the model positive, and now we know, okay, we need to be repositioned.
And when you're doing all this and you're making these decisions, obviously you're trying to build a track record because that's how you're going to eventually get into the institutions to be able to get assets, get AUM. I would guess if I was running it, the 27th, 28th, 29th, I'm like, where are we at? How are we doing? Let's close this month out or let's not.
It depends where you're at. If you're up nicely, if you're having a double-digit month, yeah, you might want to lock that in.
Yeah.
However, you want to stay true to your process because they will audit you and they want to see, okay, well, are you really trading your P&L or are you trading this model?
Yeah.
So you walk a fine line when you do that.
You guys are sticking to your model as of now?
Yeah. So we've run the model. We believe in the model. Yeah. And if I deviate from the model, it either adds doubt to people wondering, okay, is there any, do you guys really believe in yourself or not? Or they're going to think I'm just, trading the tape, we call it. Like, I don't want to be window dressing my own portfolio in the last 3 days of the month. You know how that works. Like,
yeah, it's interesting as a money manager that manages his portfolios with discretion. I'm a long guy, and I believe in the long game and dealing with these volatile times, and not trying to time the market and not trying to overanalyze it. But I'm trying to put myself into the shoes of you. And using my mindset, it's hard to do both. And you got to believe in your model, but at the same time, you have those fears or those thoughts that, like, does it hurt to really take us out of the market over this next few day period while things are a little shaky? And I think that's I wonder for you.
It's funny you mentioned that. It was like 3 months ago. We were up really nicely for the month, and we decided to just, we're going to stay true to our model. The model's positive. Even though things are volatile, we're going to stay in. And that decision, I think we gave back like 4 or 5% that month in the last 3 days.
Yeah.
And we could have easily cashed out, like you mentioned. Because, like I said, we're really trying to be institutional. We're trying to stick to, I don't think when you're managing hundreds of millions of dollars, it's that easy to go to cash whenever you want. Like, when you trade.
No, you're right. Yeah.
So we're trying to say, okay, if this was $1 billion fund, would we have gone to cash? Probably not.
Yeah, it's interesting. And it's funny because I do know the more money you end up getting, the easier it's to get on these platforms. And that's the funny thing, because you can grow from, use Cathie Wood as an example, right? You can go be real small and then all of a sudden you're on CNBC every day and then your model doesn't do well.
Right. So let's talk about Cathie. When it comes to advisors, I'm sure there are some advisors who invested in ARK, right?
Yep.
And I'm sure they're not too happy that they did so, unless they sold the top.
I'm sure there's a lot of advisors that invested, and I'm sure all of them are unhappy.
Right. How many of those advisors, though, had invested in hedge funds?
It's a good question. I don't know.
I don't know either, but I would say it's probably very few.
I would agree.
But what's the difference?
I guess the difference is that with Cathie, she was long only from what she showed. And so on a strategy basis, you go, well, I know she's not shorting anything, she's long. I would say that would be the main.
There are long only hedge funds.
Oh, there are.
Yes. So I would go back to the performance fee.
Yeah.
So I wrote down, I brought a little note here about Cathie. ARK closed, I think it was December.
By the way, we didn't do any pre-analysis. Cathie, I got nothing but respect for her. She's done a great job. A bad year for good reason, because these are bad stocks. So
and I only bring her up not to badmouth her, but just to have advisors think about the difference between investing in an ETF, a closed-end fund, or a hedge fund.
Yeah.
They're all the same thing. Even a mutual fund, you're putting your client's assets or your personal assets with a money manager. There's somebody making a decision. Unless you're in a pure passive index ETF, there's a decision maker there somewhere.
Yes.
And there's this scale between, a lot of people talk about fees and performance fees. The more active the manager in general, the higher the fee, because they're doing more.
Yes.
Right. So Cathie, for an ETF, it's a fairly highly fee from my understanding, but she's quite active. If you look at her trade, she's very active. She's very active,
yes.
right? However, she doesn't have a high watermark. The fact that Kathy is not a hedge fund, she doesn't have that 20% performance fee. Well, I calculated her high watermark right now would be the closing price of 2020. I think the stock is, let's see, where's ARK? 124.49.
Yeah.
Imagine if you were a manager and you don't get paid again until your own ETF or fund gets back above 124.99. We're in the high 30s right now.
Yeah.
So you talk about performance fees. It makes the manager make different decisions. Would she have added to losers? Would she have allowed the evaporation of the portfolio happen so quickly? I asked that as a question. I don't know.
Yeah, I would figure when you have the track record she had, knowing the volatility, knowing what your beta is, which I'm sure she knew what her risk was to the market, and her leaning into small cap technology and mid cap technology when things go bad are going to go really bad. And I have a feeling she knew that, but maybe you're right. Maybe she's chasing her high watermark, and that's,
Well, she doesn't have one. She doesn't have performance fees.
Yeah.
So I think it was 75 basis points is what her ETF charges.
Yeah.
Obviously, she wants her AUM to be higher because
she makes more for her AUM.
Premiums. Yeah, but a hedge fund, a lot of people think that the 2 and 20 or the 1 and 20, which ours is, the manager really is raking in on that 1%. And when you're running a hedge fund, there's a lot of expenses. You have a third-party administrator who has to always calculate your net asset value. You have auditors, you have legal, you have compliance, you have marketing, you have research. Most hedge funds break even on the management fee, and they really are just the performance fee makes or breaks a fund. So when you look at the research of all the funds that kind of don't make it and many don't, it's not because they blew up. It's because the manager didn't make enough to cover his operating expenses. And a lot of them fold and they return capital. They don't lose everyone's capital. They just say, hey, you know what? This limited partnership didn't work out. Here's all your money back. But the funds that do make it, those managers, when you look at your billionaires of the world, your Leon Coopermans and all these, they had performance and they reinvested in their own fund. That's another thing. I think Kathy Wood is invested in her own funds.
I'm sure.
But most hedge funds are. Like, we run our capital in the same pool that your capital and your client's capital are going to be in. So when you hurt, we hurt.
Yeah.
Yeah.
Yeah, no, it's important to have your skin in the game, and everybody's hurting in this kind of environment.
Not us.
At the end of the day, it's as you said, there's no timing the market either, right? So, there's a little timing based on your algorithm.
That's not true. You can't time the market. You can control risk.
So you can always control risk.
It's not about being right or wrong. It's about losing less when you're wrong and maximizing when you're right.
Yep.
That's all it is.
Absolutely. Yeah. Mike, you're driving home after this podcast, and you're thinking, there was one thing that I thought was kind of an interesting thing. Maybe you have it written down on that piece of paper. What would be the last thing you'd want to leave the audience with?
So to the advisors out there, just want to point out that the hedge fund industry as of Q2 2022 is a $5.1 trillion asset class. And it wouldn't be so if it didn't add value to a lot of people. So when you're doing your research on what's best for your clients' portfolios, you might want to take a look at them.
Absolutely. I think that's great advice. And alternatives should be a major sleeve for people that have listened to this podcast, know my big holdings in alternatives, especially with this kind of market. So, and hedge funds can be a great strategy and don't have to be a scary strategy either. And so getting, obviously, with a firm and having that firm do the due diligence, and then, knowing what you're getting into is a huge thing. So, Mike, I look forward to your successes. I look forward to getting that 1 year under your belt where you can really go out and start marketing. And it sounds like an awesome strategy, and I wish you nothing but the best.
Hey, thanks for having me on. I really appreciate it.
Absolutely. If anybody wants to get a hold of you, how can they reach you?
You can check out our website, krcm-fund.com. My name is Michael Kieffer. I'm on LinkedIn. Feel free to reach out. I'm a giver. I believe in giving back. So if anybody has any questions or wants to learn anything, or if you think that I can provide some value or a referral of some kind, reach out.
Excellent. And as always, this podcast is for advisors by advisors. The goal of it is just to educate what's out there. This is no endorsement on product or anything negative on product. You should do your own research and decide what's right for you and the people around you. So I hope everybody enjoyed this podcast. Mike, again, thanks for coming on, and we'll see you on the next one.
Appreciate it. Thank you.